whether you're a newbie when it comes to investing or whether or not you've been investing for 70 years. Sometimes our expectations of how our account should do are wrong. Essentially, we're not really sure how our account should be performing. Your account most likely was more aggressive when you were younger and maybe got less aggressive as you got closer to retirement or financial freedom, or when you had to tap into those funds. And when that happens, we don't really know where expectations should lie. And there's so much information out there, some of it accurate, some of it not accurate, that we just don't know what to expect when it comes to fixed income or when it comes to stocks or the mixture of both. And this can be really confusing and really hard to look at your accounts and know if you're doing okay or not. Now, I would say that your relationship, if you have somebody that's helping you invest, if you are doing it yourself, it's not always going to be completely in line with the market, depending on what you're leaning towards, depending on the different sectors that you're going into and all those kind of things. But this could give you just a baseline of kind of what to expect when you're looking at certain things. Like, we're going to mainly focus on fixed income versus stocks. And we're going to look at the historical side of things. We're going to look at how to set those expectations based on your mix and your allocation. We're also going to talk about how your mixture and your expectations really affect your journey to financial freedom, which you know I'm all about because that's what I do for people. So if that sounds good to you, then buckle up. That's what we're going to talk about. Now, just for a second, if you are new here, welcome. I'm Lisa. I'm a financial advisor, and I help people get to financial freedom as quickly as possible. If you are returning, welcome back. We're happy to have you. Okay, so let's just jump into it. And if you're wondering what I'm looking at my notes, especially in this topic, because I will go on and on about this, which is going to be incredibly boring for all of you if I did that. Also, I want to make sure I get the numbers accurate because we are going to start going through some historic data as well. Now, I'm going to put a little caveat on things. Historic data is important to know. However, that might not necessarily be your experience when it comes to investing. Like, we're going to talk about stuff like 1980s. Okay, I was baby in 1980s. I was born in 81. So that's not my experience if something happened in the 80s, right? I wasn't investing then. Or, even in 2022, maybe you're right out of college, you're starting your 401k, that's not going to be your experience either. So just keep in mind, historics are just pieces of information. It doesn't necessarily mean that that is what is happening here and now, but it does give a broader perspective. And I think in this case, looking at historics at different time periods really shows the kind of the changes that can happen. And we are going to bust some myths that I think will be very interesting to you. So let's start with fixed income, which is considered to be the steady player, right? And why I say that is people think fixed income, I hear lots of words that are not really true with fixed income. Guaranteed. No, not all fixed income is guaranteed. That's not true. I hear safe. Sometimes it's safe. Sometimes it's not so safe. So when we talk about fixed income, we really need to have those expectations in place. And actually talking about fixed income is what inspired this video to begin with, because I was talking to somebody about it. So what is fixed income? Fixed income are bonds, bond funds, CDs, treasuries, money markets. Some people might consider like a high yield savings account kind of fixed income, and you can, with planning, you can kind of consider it fixed income, but it's not when it comes to your investments, right? You can, if you have a brokerage account, you can buy a CD, you can buy a US Treasury. You cannot buy a high yield savings account in your investments, as far as I know and that I'm aware of. So at least at this point. So let's take a look at historic returns when it comes to fixed income, just to get a general gist of how fixed income has returned over time. So for long-term US bonds, historically, it's about 4%, okay? Now that, of course, is with variations depending on interest rates and the cycles and all that stuff. So let's take a look at it in a little bit more detail. In 1980s, or in the 1980s, I should say, Treasury yields were at double digits. And today, they're closer to about 3.5% to 4%, depending on the duration or how long the U.S. Treasury you're looking at right now is. For many years before this, they were very low. They were at like 0.5%, 1%, if you were lucky. And that is all because interest rates play a big role in this. And so if interest rates go up, then bonds tend to not do very well. And interest rates go down, bonds tend to do better. Is that always the case? Not always, but it does have a big impact. And I would say when I'm talking to clients about this, I say with fixed income, if we can get historical inflation rate, which is around 2.5%, that's pretty good. That's what we're aiming for. You can get more, great. Oftentimes, if you can get more than that, you might be taking on extra risk. Sometimes that's not the case, though. I mean, if you look at, this is not guaranteed, or I mean, this is just based off the data that I looked at today, looking at a U.S. Treasury. It was about, the yield to maturity was about 3.1%. I mean, that's better than inflation historics, right? So, and that was for a 9-month U.S. Treasury. Tomorrow will be completely different than what it is today. So it is a moving market. It's not fixed in terms of that's it. That's all you're going to get. Once you buy a U.S. Treasury or once you buy a CD, those prices can get fixed for the period of time that you're buying it for. However, if you're buying a bond fund or a bond, those are not guaranteed. They don't really have any kind of guarantee lock on them necessarily. Some of them do, some of them don't. You buy a longer duration bond, like a 30-year bond, that's going to have a lot more volatility than a very short-term bond. So it really just depends on a lot of things. But here's the point that I want to make that people don't realize. So 2022 was our last really big turn down. Now, people will say April of 2025 was really bad, but that was for a very short period of time, and the markets recovered as of almost October 2025. However, 2022 was a very hard year for people. And the reason it felt a lot harder for people was we hadn't had a market turn down like that without quick recovery for a very long time. Like, really, I would say 2008, 2009. We'd had some but nothing like that. And so it'd been a long time since people had experienced that kind of downturn and not had a quick recovery like we did in 2020. The other thing that happened was we had a very bad bond market. And so let's take a look at what that means. So Bloomberg US Aggregate Bond Index was down 13% in 2022. 13%. That is very large for a bond fund. It's just huge movement for a bond fund. And that was their worst performance since the index was created in 1976. So that was their worst performing year ever since it was been created. The US 10-year US Treasury dropped nearly 29%. Now, if you had it bought already, it wouldn't affect you as much, but still the rates were falling quite a bit. The ETFs were down about 13%, which is in line with the index. And some of the longer term bonds, like I just told you, the longer the duration, the longer bond that you hold has much more volatility. Some of those were down 30%. So those are big moves. Now, why was that happening? Well, it all is dependent on those interest rates. So because inflation was taking up so quickly, the Fed decided to raise the interest rates pretty quickly. Now, some people argue that they should have raised it much faster and the bond market would have recovered faster from that. Some people say that wouldn't have made a difference. I don't know what the answer is, but they kept ticking up the interest rate, and that kept hurting the bond market more. And that's one of the reasons that the bond market did so poorly, and we call it a historic year in bad bond market. So, fixed income we think of as a steady partner for us. However, it does have risk associated with it. And to believe that there's no risk when it comes to fixed income is just not true. And sometimes the risk is, a 13% drop, but sometimes the risk is you're not getting enough money or enough rate of return on it to keep up with historical inflation, which means that you are losing purchasing power, which is another risk, right? So it does have risk associated with it. It just doesn't feel as bad and as roller coastery as stocks do sometimes. They're also not as sexy as stocks, so people don't talk about them very much. So we don't know very much about them, okay? Now, like I said, stocks are often considered to be that roller coaster ride, right? We've all had that like high risk, high reward discussion. That's not always true, by the way. But basically when you're buying an individual stock, you're buying a piece of a company, shares of a company, whatever insert company that you want to buy shares of. If you are buying a a stock fund, whether it's an ETF or a mutual fund, there's lots of different stock funds out there, then you are buying a fund that owns lots of shares of lots of different companies, and that fund is going to perform based off of the sector that they're in, based off the mix that they have, based off of their objective. Are they a growth stock, a value stock? I mean, we could get in the weeds on this, and I will not take you down that road because we will never be done with this. But if we just take a look at the S&P 500, which is an index of U.S. companies, 500 of the largest U.S. Companies in the U.S., the U.S. companies in the U.S. So the S&P 500 has averaged around 10% annually over the past 100 years, and before inflation. And those returns can be lumpy, though. I mean, we had the dot-com crash, which was down 49%. The 2008, 2009, Great Recession, that was down 57%. Pandemic was down 34% before it did that kind of bounce back. By the end of the year, 2022 was not a great year either in the stocks. And so we look at nice, average rate of return of 10%, let's say, because remember, that's only one index, there's only one set of stocks, but we can have to start with something, right? So we're going to look at the S&P 500. 10% on an annual basis is wonderful, but you do have those periods that are really painful to get through. I mean, down 49%. Ugh, it's just it's not great. But overall, when you invest in stocks, there is a thing called compound interest, which means that interest builds on itself over time. And we've all seen those charts that say, if you had $10,000 and you invested in 1990 in the S&P 500, you'd have over $200,000 today without adding to it, despite all the turndowns. And that is true historically. That's most of those things are put together with historical data. And so, stocks can definitely be that up and down ride. They are not comfortable to be in when you're down mode. And, but, overall, historically, they've performed. Does that mean that you should be all in stocks and just not care about the downturns? No, you've got to find that right mix for you, because fixed income, despite having really bad times like 2022, can be a nice leveler, can be a nice cushion, so that, if we have another, I hope we never do, but if we have another 2008, 2009 issue and the market goes down, what did I say, 57%? Yeah, 57%. Those bonds can be a stabilizer during that time, and were much more than in 2022. Like I said, 2022 was just a weird time in the markets for bond market. So oftentimes you'll hear of this 60-40 portfolio. 60% stocks, 40% bonds. That's the, you'll read a lot of places saying that's the ideal mix. It's not the ideal mix. It might be the right mix for you. It might not be, But you do need to know what mixture of stocks and bonds you have, because it makes it easier to judge where you should be, right? If, let's say, the S&P 500 is performing 10%, a year at a given year, and you're at a 60-40 portfolio, well, then you should be at about 6 to 7%, let's say. And that's doing okay with that. Yes, you could say, well, if the bonds were doing that, but let's say 6 to 7%. And if I looked at the mix and everything, that's pretty good. That's kind of in line with the market, because you've got 60% in, if you're looking at it towards the S&P 500, 60% is in stocks. Maybe not just the S&P 500. You might have a mixture of different things in there, but it can give you a little bit more of an understanding of where to see it, because now you're not looking at your portfolio and going, I'm at 6 and they're supposed to be at 10. You've got to have an understanding of the mixture and how that works with the index that you're looking at. Index is just kind of a rule of thumb kind of way of looking at the markets, but it's not necessarily always the way you want to base what your portfolio is doing. So just to put that out there. So essentially, think of your allocation is you have to find the right mix. Like, it's finding the right outfit for the day, right? Although you don't change it for the day, you find the right outfit for that time in your life. And you can change it. It should be changing over time. A lot of times when I start a conversation with a client, I say, anything's changed, anything's different. Is there any reason that your allocation shouldn't be this mix that we have? And if things haven't changed, I don't see a reason to change the necessarily risk matrix, unless there's something in particular that's going on with that particular client. However, sometimes people retire, people, change jobs, people lose jobs, people get different jobs that pay more. You have life happening. And so those sometimes do trigger changes in your allocation mix between stocks and bonds. So, you've got to set a realistic expectation for yourself. And I would say you'd want to say, instead of necessarily looking at at how things are doing this year, you might want to say, I want to get this amount of rate of return annualized. It's not going to be every year, obviously, because we're going to have bad years. But you set a little line of yourself of what do I expect this account to do? And have a real deep conversation with the person that you're doing investing with on what that mix looks like, and what do downturn years look like historically, right? We can't predict the future, but we can look at historically how this mix has done. Are you okay with that? Are you not okay with that? Does that make your stomach turn? It makes everybody's stomach turn because we have some bad years, obviously. But you do need to be aware of the highs and the lows of the mix. And really, any of us who do investing can show you that, and you should be looking at that. And you guys should be looking at that pretty regularly with your advisor. If you feel like expectations are not lining up, that needs to be a constant conversation in your meetings that you're having. So essentially, you've got to keep some of these things in mind when you're setting expectations. Remembering that fixed income can be a stabilizer, but is not always a stabilizer. It moves too, doesn't tend to move as quickly or as volatile in as much of a volatile fashion as stocks do, but it does move. Stocks can move very fast, especially if you're holding individual stocks. Those can move very, very quickly. So expect that. And there's going to be up and downs, and You know, those are those times that maybe you just don't look for a little bit. You want to be involved, but you also don't want to make yourself do something that is not the right move to do because you're emotionally tied to it. That's a whole other video. And then remember that it is not timing the market, okay? We are trying to look at the time in the market and build and grow on that side of it rather than timing things. Yes, there are better days to invest, you know, to get your money invested than others, et cetera, et cetera. But in the long run, it is not about timing the market. It is about time in the market. And I would say, you know, you have to look at real world examples. Like, you know, some people who were in the markets in 2008 had to stay fully invested in their allocation for maybe 5 years or more to really fully recover, to feel that recovery. That feels like a long time, but I tell you, those people are really happy they did it. And oftentimes I hear a lot of people who have sold out of the market, out of fear and regret it. Some, I have met a couple who don't, but a lot do. So you do want to make sure that your allocation, your mix, and your understanding of your risk align up so that when we do hit things like that, hopefully we will never hit that kind of market again, but I can't tell you we won't. And if that is happening, you want to know what that risk looks like. And you should always look at your portfolio. And if the funds and the things that you're looking at go back far enough, you should look and see how it did in 2008, 2009 in particular, because you're really going to be tested then. And 2020, especially if you have fixed income, you want to see how the fixed income did during that time. Not 2020, 2022, excuse me, because we did have a really bad bond market during that year. So just remember, at the end of the day, the basically the sizzle is the stocks, right? And the bonds are more like the protein or the meat, right? And combined, they make a delicious steak, right? You just want to understand how much we want to put together, and they're going to combine together and make a balanced meal for you. That probably wasn't the best. That wasn't the best analogy, but you get my drift on that. So maybe vegetables and steak. I don't know. Maybe I'll change it up. Okay, so with that, this is going a little long, and I was looking at notes and it's still going long. So I'm going to wrap it up. I hope that really helped you understand expectations in the market, what to be thinking about. And then I guess the one thing I really want you to take away is knowing historics is important. Knowing historics at different times are important, but there is no science to this, okay? There's no genie in a bottle telling us how to do it. We have to continue to have conversations. We have to continue to look at things, see how it's doing to the overall market, look at many different indexes to see how things are performing, talk about risk, talk about returns, talk about that. Should that be all of your conversation with your financial advisor? I hope not, because you have lots of other planning things to take a look at rather than just rate of return. But obviously rate of return's a very important part of it. And so having those conversations are extremely important. And hopefully you get some satisfaction of knowing just that this is not a science and that this has to take time and energy. And it's not set and forget. It just isn't. And if you do that, it's possible you could be unhappy with the results. So stay involved, I guess, is my overall theme. Hopefully you found that helpful. Let me know if I can help in any way. And until next time, stay strong, do the good things out there, be kind to one another, and we will see you on the next video. Bye-bye.